yeah, I'm very excited to do this webinar with you guys. I'll first introduce myself briefly. My name is Nick Kraakman. I'm the founder of valuespreadsheet.com. And yeah, the reason why I'm giving this webinar is because I see so many people around me who constantly lose money on the stock market. I know how hard it is to get started, but many people just sort of yeah, they miss some basic understanding, or they just happen to find the wrong guy who tells them the wrong strategy, and that's why they consistently lose money. And it's such a shame because they save all their lives, they save for years to get get some savings together, and then they put it in the market and they lose almost all of it. I mean, that's also what happened to me. Only I started very young, at a very young age, with investing. So when I lost my money, it wasn't that, yeah, well, now that I look back at it, it wasn't that big of a deal because it wasn't that much money yet. But we'll cover that story later. So the reason I am holding this webinar is because yeah, I don't want people to make the same mistakes as I made. I mean, now I'm consistently earning, yeah, above average returns, but before that I lost half my savings, and therefore I'll share my story with you today and the breakthroughs I made along the way. So the things that I found out that I wish I had known from the start. So I hope you guys can learn a thing or two from this. And at the end of this webinar, you will know exactly how to avoid all the costly mistakes that I made, and you will be ready to start earning serious money on the stock market. Like I said, I'm from Amsterdam, the Netherlands. It's a beautiful city, really. And no, I do not smoke weed. English is not my native language, however, so apologies in advance if I happen to ruin some grammar here and there. Yeah, so I want to make this webinar a bit interactive, so I can yeah, sort of tailor the content to what you want to know. If that is all right with you. Yeah, so there is this chat functionality. Some of you guys have already found it. That's great. I see Andrew is from South Africa. That's amazing. Malaysia even. Wow. Yeah, so many different time zones. It's it's a wonder that everyone was able to make it at this time. I actually think I sort of messed up because I said in the introduction that yeah, that it would start at 11 a.m. PST, but I think there's daylight saving time or something, so that might be why some of the people are not yet in the room. They might think it starts an hour later, so I have to be more careful with that in the future. Okay, so in the coming hour, I'll try to teach you as much as I possibly can about value investing and the things I learned along the way. And after that, I'll show you how you can get more help if you wish. Is that okay? So yeah, by the way, I finished writing an ebook yesterday about the strategies of the 10 best value investors in the world, including Warren Buffett, Peter Lynch, Joel Greenblatt, and a couple of others. So if you guys are interested in that, please remind me at the end of the webinar during the Q&A. Then I'll give it to you. Yeah, we'll first cover all the content, and then yeah, at the end there's plenty of room for questions and answers. So just remind me, and I'll give you the link to the PDF file of the ebook. You guys will be the first to read it. So I'm very curious what you think about it. It was very interesting to figure all of it out. You know, how the best investors in the world think about investing. It's interesting to see that they all sort of follow a value investing strategy, but they all have their own little tweaks, and you can read all about it in the PDF. Yeah, but first let's start with the content of this webinar, which is my investment journey so far, and the sometimes painful lessons I learned along the way. So this is me with my two lovely younger sisters. At this time, I did not know anything about investing yet. I also didn't know why my two front teeth were so enormous, but that's a different story. So some 10 years ago, during middle school, I sat next to this guy. His name is Thomas, and as you might be able to tell from his appearance, he is a typical business guy. And he already had this in him back then, so that was 10 years ago. I was 14. And in fact, this picture of him is made for a Dutch newspaper, because he started his own business, his own accounting firm, and now, yeah, this was the picture they took for it. So what he told me in class that his father was investing, and I had no idea what that is, what that meant. I mean, I had never invested before in my life, so I didn't even know what a stock was. However, he told me that his father just earned some money, he then invested it, and a couple of days, weeks, months later, he would get more money out. And that seemed like magic to me. I mean, you put some money into something and then you get more money back. I think that sounds amazing. I want to do that as well. So I immediately wanted to start. So what I did, I came home, yeah, like everyone does, open your internet browser and look for how to do this, because he told me about investing, but he wasn't investing himself, so he couldn't tell me how to get started. I soon found out that all you really need is a little bit of money and a brokerage account. So I looked for one of the biggest ones in Holland, where I'm from the Netherlands, and yeah, um, I requested to open a brokerage account with them. The problem was I was 14 years old. You had to be 18 to open an account, so my parents had to sign for this first. And I just brought them the paper, like, oh, Dad, Mom, Dad, can you please sign this? And they did. And I was like, oh, I expected this to be a bit more of a problem, but no, they didn't really seem to think about it, and they just signed it. So I'm still grateful for that, but it just seems that like they didn't really think about it that much. So, but yeah, like if they hadn't done that, I wouldn't have been able to learn so much about investing at such a young age. So I'm really grateful for that. So by this time, what I had was a brokerage account, a promise of easy money, and exactly zero knowledge about the stock market and how it functioned. I mean, I didn't know anything except for what my friend at school told me. So I felt absolutely ready to put all my savings on the line. And so I did. I put all my savings on the line. Remember, I was 14 years old, so it wasn't that much, but still, all my savings. My strategy was pretty simple back then. What I did was really just take a look at the list of all the stocks that were trading on that were available to me, which were a lot of Dutch stocks, and also a lot of stocks from the UK and from the US, which I could purchase from my Dutch brokerage account. And I just looked through the list up and down, and whenever I saw a company that sort of, yeah, that I knew, so I knew the name, I had heard the name of the company before, I would click on it, and then I would look at the chart. And if the current price was lower than it had been in the past, that was all I looked at. So I looked at a chart of a company that I knew, and then looked if the price was lower than it was a week or a month or a year ago. And if that was the case, I would buy it. And of course, this is a pretty silly strategy. However, I did get lucky a few times. So I earned some money, and my friend Thomas, who I told you about earlier, he was actually amazed. He says, "Man, how are you doing this?" Of course, in the end, I lost a lot of money with this strategy because it was purely based on luck and not on any skill whatsoever. The stock picking I did was based on thin air, really. So this brings me to my first breakthrough, which is that you should buy a business and not a chart. I mean, stocks are parts of a business, but I did not realize that at the time. I thought stocks were things that wiggle up and down in price. However, only later I found out that price actually says very little about a company. That price is actually sort of stock prices are set by irrational decisions made by groups of investors. So this buying based on price um, is a bit silly, and that's why I lost money with this. So whenever you buy a business or whenever you buy a stock, just keep in your head that a stock is essentially a part of a business. There was once a business, and they decided to split themselves up into tiny little pieces. And each stock represents one of these tiny pieces of the company. And so the performance of a stock is related to the performance of the business. And that's something you should really keep in mind, and that's something I didn't know at the beginning. So I bought stocks when their price was cheaper than it had been in the past, and this only means that the stocks were relatively cheap. But this does not mean that the stocks were absolutely cheap. So let me explain what I mean with this. For example, if there's a couch and it's selling for $1,000 at first, and a few weeks later it is selling for $500. It is now relatively cheap compared to the initial price of 1,000. However, if the couch is only really worth $100, it is still expensive in an absolute sense. So I had this very flawed strategy of buying relatively cheap stocks, just looking at the price. But in the end, when you learn more about value investing, you understand that you shouldn't compare the current price with a previous price. You should compare the current price to the actual value of that stock, of that piece of a business. But we'll cover that some later on in this presentation. So I was 14 years old. I had not much money to invest, and so I realized that even if I would make really good returns percentage-wise, for example, I would earn 20%, which is a very, very good return on investment, I would still not make a lot of money. The reason was because I had such a small initial investment to work with. Also, the transaction cost really sort of destroyed all of my returns. So whenever I would earn like a couple of, let's say I would earn $100, I would have $30 transaction costs, and so that was 30% of my returns were gone just due to transaction costs. Actually, I got really pissed about this when I sold my first stock. I thought, wow, I have a 10% profit. This is great. And then I saw what was left after the transaction costs were deducted. And I sent my broker an angry email because I didn't understand. I asked him, like, what are you doing? Why are you charging me so many transaction costs? Many here. This is what I mean, guys. I'm from Amsterdam, English. I'm trying. Okay. Yeah. So I asked them, why are you charging me so much, such high transaction costs? I mean, it's wiping out all my earnings, all my returns. Of course, they laughed a bit at it and said that, yeah, that's how it works, and it was some sort of a reality check for me. So this is a thing you can keep in mind as well, that transaction costs can really impact your returns. So that's when I found out about leverage, actually. So leverage allows you to earn more money with a small investment. So normally, for example, if you invest, let's say a couple $1,000, and you earn a 10% return, that's great. But now, if for example, if you have options or turbos or speeders or any other crazy leverage products, you're able to actually multiply that return. So if the stock goes up by 10%, your investment might go up 40%. However, this sounds brilliant. This sounds amazing. I mean, I was hooked right from the start. I thought, wow, this is my ticket to wealth. I mean, I would just pick something with serious leverage, and then I could make a lot of money with my small investment. However, what I did not realize was that leverage also works the other way. So if a stock, like I said before, if a stock increases 10% and you have a multiplier of 4, you have leverage of 4 times yeah, that it multiplies by 4. So if the stock goes up by 10%, you earn 40%. But if the stock goes down by 10%, you lose 40%. And this was something I did not realize. And this is the sole reason why I lost half my savings in a matter of weeks. So I was 14 years old. Had not spent much money on anything really. I saved it all my life up until then. So what I saved in 14 years, I lost half of that in just a couple of weeks because I used leverage. It went dramatically wrong. So yeah, I was not really happy actually. I felt a bit like this cat, the grumpy cat. However, I did learn a lot. I learned a lot from this. It was a big reality check, a wake-up call, and that brings me to my second breakthrough. It was the realization that there is no shortcut to wealth. And this is a big one. I mean, many people try to sell you these get-rich-quick schemes, but that's just not how it works on the stock market. Quick and easy gains are something everyone wants, but it is simply not possible to maintain this. You might be lucky a couple of times, but in the end it will backfire so hard that it will wipe out everything you earned beforehand. So it's just not worth the risk, guys. Please stay away from leverage. It's not worth it. Um, Besides, it's really hard to earn back losses. For example, so that's why it's very hard to earn back losses, and that's why you should really focus on avoiding losses. That should be your primary motive actually, because if you lose 10%, it requires you to earn 11% to earn that 10% back. However, if you lose 50%, so if you lose half of the money you invested, it requires 100% gain in order to earn that 50% back. You know what I mean? I mean, if you have $1,000 and you lose half, you only have $500 left. That means that if you want to earn back that $500 you lost, you need to make 100% on that $500 you have left. So this is huge. It's really hard to earn back losses. So please try to avoid these at all costs. On the stock market, there are no quick gains. I mean, if there are, they are lucky gains and they are not sustainable. So don't focus on them. In the end, slow and steady wins the race on the stock market. Because what you get then, if you use time as your friend, if you see time on the stock market as your friend, you unlock the power of compounding. And compounding, for the people who don't know, it's a very, very important trick of rich people. Actually, what it is, it's interest upon interest. So let's say you have $1,000, you earn 10% return. That means you now have $1,100 because the 10% return on $1,000 is 100, and add these up, you have 1,100. Now the next year, if you earn 10%, you earn 10% over 1,100 instead of over 1,000, and that's more. So this just seems like a tiny little thing, but if you let your investments compound over the years, it's really, really, really adds up. Einstein once said that compounding interest is the eighth wonder of the world, and it really is. It's really, really powerful, and so time is your friend, and there are no shortcuts to wealth. So take it slow. Another thing I learned from losing half my savings was that it might not be the best idea to invest every single penny of your savings at once. Instead, I now recommend people to invest only with money they won't need in the next 5 years. So start with a small sum of money and then automatically transfer a fixed percentage of your monthly income to your brokerage account. This really adds up over time. I myself, I try to do transfer between 10 and 20% of my monthly income to my brokerage account, and I do this at the beginning of each month. And why I do it at the beginning of each month is because if I would do it at the end, I probably have already spent my income for that month. You know what I mean? If you if you earn money from your job, for example, you earn it at the beginning of the month, and if you then immediately transfer 10% of that to your brokerage account, you won't really miss that money during the rest of the month. However, if you wait until the end, you probably have already spent all the money and there's no 10% left to transfer, you know what I mean? So I really recommend to transfer just a fixed percentage of your monthly income to your investment account, and yeah, do this at the beginning of the month. This really adds up, and yeah, this is the way to steadily grow your asset base, and and also you don't go all in. You don't invest. You don't risk all your savings. You just risk a certain percentage of your income. So you limit the risk you have, and yeah, that's a good thing, I guess. I'm going to try something here because I'm very curious about you guys. Actually, I created this poll here. I'll try to publish it. Start poll. Do you guys see it? The question is, how long have you been investing? You should be able to answer it. So it will be very interesting for me to see. Yeah, how long have you guys been investing? Less than 1 year, between 1 and 5 years, or more than 5 years? Because I sent you all these emails and write all these blog posts, etc. But I'm really curious who I am sending all this stuff to. What your skill set is at the moment. So feel free to answer the poll. I think you have to click the polls tab first in the. Oh well, I'll just continue with my story in the meantime, and we'll look at that later. So yeah, so after I lost so much money, after I lost half my savings, I really realized that I had no clue what I was doing. I needed a strategy. I mean, you don't drive a car without learning how to drive first. And it's exactly the same with investing, of course. And legendary investor Joe Greenblatt described my situation pretty accurately, if I can say so. He said, choosing individual stocks without any idea of what you're looking for is like running through a dynamite factory with a burning match. You may live, but you're still an idiot. And I was the idiot because I was picking stocks, but I had no idea what I was looking for. Like I said, I was just picking them at random, sort of companies that I knew based on price alone. It was silly. I had no idea what I was doing. And this led to a very important breakthrough, that you should first invest in knowledge before you invest in stocks. I mean, I lost half my savings because I knew nothing about the stock market. I was picking stocks at random, and I was even using leverage to make things worse. So this is something I can really, really want to hammer home here, that you should first invest in knowledge before you invest in stocks. This will save you a lot of losses. Yeah, it will save you a tremendous amount of losses, and yeah, that's what we're here for, right? To learn how to avoid some painful mistakes. And this was one of the biggest mistakes I think I made, to just blindly go all in with all of my savings, no strategy whatsoever. So please don't make this same mistake, guys. As Benjamin Franklin actually said, that an investment in knowledge pays the best interest. And yeah, I found out the hard way. You don't have to now, because you just heard me tell you that you know how it works. Yeah, so I was wondering, where could I learn about investing? Where could I find a good investment strategy? Of course, I tried the internet, but this was one big drama actually, because I didn't know which sources I could trust. It was all contradicting information. One website was telling me about technical analysis, just looking at charts and then drawing lines on them and whatever, predicting all kinds of weird stuff. Other newsletters and websites were telling me to look at a company and try to find out if it's profitable or not. It was just very contradicting information. Everyone was shouting something else. Everyone appeared to be a guru of some sort, but I couldn't really find out if they were actually making money. All the information was scattered around, you know. So there was an article here, an ebook there, a video there. It was just all very fragmented. They were all get-rich-quick schemes, and there didn't really seem to be sort of a comprehensive explanation of how you could actually go from a beginner to a pro, how you could actually consistently make money on the stock market. And then I realized something. Why don't I just do what you should do in any field, and whenever you want to learn something, is to look at the very best. What are the very best in the world doing to earn money on the stock market? And of course, the first guy I came across was Warren Buffett. His strategy, he is, for the people who don't know him, and I doubt there are many who don't know him, but he's the world's best investor ever. He has made billions and billions with investing. He is actually the third richest man in the world, and he earned all of his money with investing. So, of course, this story really sort of stuck with me. I thought, wow, this is amazing. This guy knows what he's doing. So I came across this free Warren Buffett newsletter. It was in Dutch, which was fine. I mean, I was only investing in Dutch stocks at that particular moment, so that was great. This newsletter, every week they would send an article, and slowly but steadily, I just started to piece everything together. You know, every newsletter I received was sort of unveiled some of the secrets of Warren Buffett, and then they sent me this ebook which explained his strategy, and it was amazing. I mean, it just opened my eyes to how investing really works on the big level, how the big guys do it, you know. So the funny thing was that I found out that his strategy wasn't complex. It was actually fairly simple, and it made a lot of sense. It was logical, you know. When I read about technical analysis, I just got confused. I mean, what do all these lines and indicators mean? No idea, really. But then Warren Buffett's strategy was to look for great companies which are really profitable, have low debt levels and great management, and then buy them when they are cheap. This is so simple. I mean, what he said was, whether we're talking about socks or stocks, I like buying quality merchandise when it is marked down. And when I read this quote, I thought, wow, this is so simple, so logical. I immediately had the feeling like this is the thing that will work. So I really, dove straight in. Dove? Is that even a word? I don't know. So I started to really study this guy, study his strategy, and why it worked, and it started to make more and more sense. And the reason why it's a very simple strategy, but the reason why not many people apply this is because it takes some courage. I mean, while many people prefer to invest in companies which are hyped by the news and which everyone else is also buying, Buffett often buys companies no one else wants, at least not at that moment. This can be very scary. It's contrarian. You go against the crowd. But this leads to the best returns. So when I found out about Warren Buffett, I also found out, of course, about other amazing investors. I started reading a lot of books on investing, written by these great investing geniuses, like The Intelligent Investor by Benjamin Graham, which is really a classic. Benjamin Graham is sometimes called the father of value investing, and he is also the mentor of Warren Buffett. I also read the little book that beats the market by Joe Greenblatt, which also opened my eyes to. He has it's value investing, all right, but in this book he sort of explains a very simple way to apply it. Yeah, I liked it. It was a good book, and Joe Greenblatt is really a legend. I mean, his returns are amazing, higher than 30% for decades at a time. I mean, amazing. And then Monish Pabrai. This was actually one of my favorite books at that time, The Dondo Investor. Monish Babrai is also an amazing investor, huge returns, his own fund, and once had lunch with Warren Buffett. That seems to be what he is known for. Uh, very weird. He paid a couple $1,000 just to have lunch with Warren Buffett, but if that's what you want to be known for, that's fine. But his book is actually really good, and he's a very smart guy. So all of these books are written by some of the best investors in the world, and the cool thing was that they were all saying similar things. There was no more contradiction. Remember what I said when I was looking on the internet, everyone was saying something else, but now I was focusing only on what the best in the world were doing, and they were all saying the same thing. So that gave me confidence that what they were saying actually was true, or at least that actually worked. They were all applying a value investing strategy. And this strategy is what I've been applying ever since. It all became clear when I was reading all these books. So my next breakthrough was that the number one way to really learn how to consistently earn money on the stock market is to study how the best in the world are doing it. For decades on end, they have proven that their strategies work. There's no better source of information than their words. And you don't have to copy their strategy literally, but just follow Bruce Lee's advice. Adapt what is useful, reject what is useless, and add what is specifically your own. So, just as I was buying my first stocks based on Warren Buffett's strategy, the financial crisis started. So the timing wasn't ideal. In fact, I actually bought some stocks on the day the Dutch stock market hit its absolute peak. So again, the timing wasn't great. The price of some of my stocks actually dropped more than 50%. Before I would have panicked and sold them, definitely. But now I had the confidence that my purchase decision was right, that I would eventually still make money with these stocks, even though they dropped so far, so deep, so low. And I did make money with them. It took several years, but in the end, they still earned me a nice annual return. And this wasn't bad for a beginner. I mean, however, I did realize I made a huge mistake again, because the crisis made all kinds of stocks ridiculously cheap, and I wanted to buy them all. The only problem was that I was already fully invested and could therefore not benefit from the bargain prices the crisis produced. I could also not buy more of the stocks I already owned to lower my average purchase price. As I said before, I still made money, but it could have been much more if I only had some money left on my account when these prices declined. Therefore, I suggest to always keep some liquidity, so you can benefit from new opportunities. Something related to this is to never buy a full position in one go, but buy a small position first and then buy more as prices decline. So just have some money on your account. Don't feel forced to always be fully invested. And yeah, when prices, just start with a small position, buy a couple of stocks, and when prices start to decline, you can always buy more. And the effect this has is that you lower your average purchase price, which means you have more upside potential and less downside potential. So keep some liquidity. About this time, I went to university. I decided to study international business administration because, yeah, I really like business. And by now, I also really liked investing because I actually started to earn some money by applying this value investing strategy. This strategy I'd been reading so much about. Therefore, I decided to enroll in some finance courses as well. However, I was shocked by what they were teaching there. I mean, it was university, finance, and what they were teaching were outdated theories that have been proven wrong time and time again by these big investors I just told you about. They taught me the efficient market hypothesis, the capital asset pricing model, modern portfolio theory. And you don't have to know what all of these are, but just take it from me that these things are wrong, and they're still teaching them at universities. Because everything they teach is contrary to what investors like Warren Buffett believe. For example, the efficient market hypothesis says that investors always act rationally. And this is why stock prices, according to this theory at least, always perfectly reflect all available information. According to this theory, it is impossible to consistently earn above average returns for extended periods of time. But this is exactly what Warren Buffett and other great investors have done. So for my bachelor thesis, I decided to investigate whether Warren Buffett's success could be explained by sheer luck alone. And of course, once I started analyzing all of this, all of his results over time, his outperformance is so significant that it could not be due to luck alone. There's a lot of skill involved, and the way he invests actually has significant impact on its returns. So what he sort of proved by outperforming the market over, what is it, 40, 50 years, he has shown that the efficient market hypothesis does not hold, because it is possible to consistently earn above average returns. You just have to know what you're doing. And again, this theory, this wrong theory, is taught in all universities. All finance curriculums include this. So my next breakthrough was this: always question conventional wisdom. Because if the majority of people believe something is true, this does not automatically make it true. Always think for yourself and never blindly accept things other people tell you. Not even me, okay? Don't trust everything I say. Just think for yourself. Always think for yourself. Yeah, so breakthrough 7. Okay, so how are you guys doing? Still enjoying the show? We're let's see. Oh, I'm sort of running out of time, I see. Okay. I thought I was already talking quite quickly, but let's continue. Yeah, so because I was constantly performing the same calculations for each company I was analyzing, I decided to download a couple of Excel spreadsheets to speed up these calculations. I tweaked them to my own needs, and I really felt sort of in control. I was now able to analyze stocks based on many of Warren Buffett's criteria in just minutes, and could quickly decide whether to buy a company or not. I had some success, but at one point I analyzed an education company. The company was called Apollo Group. I ran its financial figures through my spreadsheets, and it seemed like an amazing company to buy. I mean, it was highly profitable, had little debt, and was also trading at a very cheap price. I immediately bought it at a price of 56. 60. Yeah, 56, believing it was worth around $90. Its stock price started declining, and I decided to buy even more Apollo Group stocks. It wasn't until I had lost around 50% of my investment that I looked past the numbers and found out that the new laws had been issued. And these laws meant that Apollo Group would most likely not be able to remain as profitable as it had been in the past. The company was also being sued from all sides, and might even have to pay a serious fine. So after the stock had dropped an additional 10%, I finally decided to take a loss and get out of this sinking ship. Someone is leaving us. Call in to break up the call. Yeah, guys. So this webinar is recorded as well, so you'll be able to look back and listen to it again if you want, or if you have to leave, like Colin, he has to leave now. I'll send you a link of the recording, so don't sweat it. So yeah, so like I said, I decided to leave Apollo to sell Apollo Group after I took a loss of more than 60%. And what I learned from this is that numbers do not tell you the complete story. While spreadsheets can really help you to speed up your research, there's much more to a company than its current profitability. So look past the numbers and also find out what the risk factors are. Think about what could go wrong. What is the possible downside? Don't just look at how much profits they're making now, because things change, okay? So always plan for the worst, you know? You always have to do some manual research, so don't just blindly trust the output of spreadsheets or whatever tools you're using. You know, there's also some manual research. Always have to look at the company itself and not just at the financial figures, although it plays a very big role, of course. So another thing this dramatic trade taught me was that you do not have to earn your money back the way you lost it. This was really, it now seems like a no-brainer, but at that point it was really an eye-opener because I held on to my Apollo Group stocks for way too long because I was afraid of taking a loss. I mean, 50% loss would have been. I thought this is a disaster. I just have to wait um, until it sort of goes up again. But this not only forced me to sell at an even bigger loss later on, it also meant I incurred significant opportunity cost because I could have invested that money in something else, a better opportunity, not a sinking ship. So whenever you find out you have a sinking ship in your portfolio, just take a loss and invest that money in a better opportunity. Luckily, I learned from this mistake and I have never experienced a loss like that again. Cross my fingers, knock on wood. How do you say that? Still, I really believed in the power of spreadsheets. So what I did, I created sort of an Uber spreadsheet by combining all the Excel files I was using into just one. And this saved me a tremendous amount of time when analyzing stocks, and I use this, yeah, I sort of call it the one spreadsheet to rule them all. I used this very successfully for a couple of years. For example, I found a tiny company called Universal Insurance Holdings. At that time, it was trading for $6 per share, while it had $8 per share in cash on its balance sheet. This meant that even if the company would go bankrupt that same day, I would still make money. That's great. I mean, besides this wonderful situation, the company also paid a dividend of nearly 10%. This was as close to a sure thing as I would ever get. Still, the stock price declined another 50% because I just suffered this major loss with Apollo Group. I was paralyzed and scared to buy more. Still, no matter how critically I looked at Universal Insurance Holdings, there really seemed to be nothing wrong with it, despite its declining price. So finally, after 3 years of underperformance, the stock experienced a huge price appreciation. I took a small profit by selling some stocks at $8, just to be sure, but I believed the company was still significantly undervalued. I held on and finally sold them at more than $14 per share. This was an amazing 155% return, including dividends. And even if you divide this by the 3 years it took to earn this return, it's still pretty amazing. So even though the stock underperformed for 3 years straight, in the end it earned me a huge return on investment. Just imagine how much I would have earned if I had bought some more when the price declined. So this is how I learned that you might underperform for a while, but that's fine, because this does not mean the strategy does not work. Your annual performance does not matter. At, not matter at all, actually, because all that matters is how much money you ultimately earn in the end. This was something all the books I read about value investing had told me already, but it wasn't until I experienced it myself that I started to believe it. So I see Sunny asked me a question. What key point generally focused in 10K reports? And as a learning experience, what did you miss in your 10K analysis, for example, Apollo Group stock? Yeah, sure, Sunny. What did I miss by reading the 10K reports? Well, my problem back then was when I first started value investing, yes, I read all the reports. I was doing fine. But then when I got these spreadsheets, I sort of thought, wow, this is much faster than reading all the reports. I just enter all these financial figures and then, you know, I know all I need to know. I was wrong because not everything is in the figures. Some things are in the report. Some things are in the risk factor section of the 10Q reports, for example. Um, they have this section in every report where the company mentions some risk factors, and maybe in there you could have found out about the fact that these laws are put into place which limit the profitability of the company. So yeah, I missed those things, and that really cost me dearly. So that's why I said, don't just focus on the figures, but also focus on what the company is doing and what is going on in the industry. Don't put too much emphasis on it, but in the end, it's not all in the numbers. It's also some, yeah, I call it qualitative analysis. So just looking at the business model, looking at what laws are put into place, looking at management, things like that. You don't find that in the numbers. You actually have to dig deeper. So okay, let's quickly continue. Yeah, so it was around this time that I read The 4-Hour Workweek by Tim Ferriss. Uh, and I really love this book. It's one of my favorites. It was really an eye-opener for me. And while the book does not cover investing directly, it did inspire me to make my Uber spreadsheet available for others. I made the spreadsheet a bit more professional, added some extra functionalities, and then I started the website valuespreadsheet.com. And this was almost 2 years ago. Let's see. No, is the spreadsheet usable for other stock exchanges? No, sorry, that's not the case. The thing is, if, the spreadsheet gets the data from yeah, from online sources, and every every country has different sources, the different websites where all the um, financial statements are yeah, published or whatever. And the thing is, if you want, you could make it work for a different country for sure. It just takes a lot of time because you have to change all the functions to sort of target those other websites, if you understand what I mean. So it could be done, but at this point it only works for US listed companies. Craig said, I purchased a spreadsheet, not being able to use it. Can you send me a link where there's information? Oh yeah, sure, Craig. I'll send it to you later on. Um, there are tutorials on my website. You can just go to valuespreadsheet.com, and there's a button in the top menu. It says tutorials. There you can find out how you can use the spreadsheet. But I mean, this presentation is not really about my spreadsheet actually, but but still, just ask away, of course. Yeah, so on my website, I write about value investing and try to help as many investors as possible to improve their returns based on the teachings of the best investors in the world. I also offer some free spreadsheets. I am sure some of you guys have used this. Uh, I have some videos up there, value investing resources, so that you can find all the resources that I prefer to use, so like stock screeners and ebooks and blogs, etc. And of course, my premium value spreadsheet is also on there. Also, I recently released a free value investing podcast. I don't know if all of you guys know about that. You can check out the first 11 episodes of that podcast by going to valuespreadsheet.com/podcast. I'll try to, 1 second, I'll put it on the, okay. Let's see, I'll put it in the, whoops. Yes, there it is. It's in the chat. In the chat room, you can find a link to the podcast. So while I already knew a lot about investing, writing, because not because I was born with it, but because I, of course, like I told you before, I started reading and really studying all these investment grades, and I wrote my bachelor thesis on Warren Buffett's strategy. So I knew quite a lot about investing when I started the website. But writing all these articles and creating all these resources has taught me so much more. It really forced me to keep learning new things. And to quote one of my favorite authors, Mark Twain, the man who doesn't read good books has no advantage over the man who can't read them. So just read and learn. And that's this breakthrough 11. That's why I believe it is very important to never stop learning. Even if you think you know everything already, there are always new things for you to learn. And I don't mean that you should read about investing all day, every day. Not at all, actually. I mean, I believe you should learn a little about a lot. And this is something which Warren Buffett's business partner, Charlie Munger, also practices. At one point, I actually heard him say in an interview that his kids sometimes call him a book with legs because he just keeps on reading stuff all the time. And he reads about all kinds of topics, not just investing. So, yeah, I suggest you do the same. Never ever stop learning, because there's always new stuff, new information to augment your knowledge and then grow your brain. So, I started applying a value investing strategy in 2007, and I've been consistently earning above average returns ever since. And to give you an idea, here are all of the companies I owned since 2007 with their returns at the moment I sold them. This includes transaction costs and dividends. And this list does not include my current holdings, by the way. And really, I have been doubting for a very long time whether or not to show this list, but I really think it might just help to bring my point across. You have to keep in mind that these figures do not tell the whole story, because some of these returns I earned in a matter of months, while some took several years to accumulate. And still, on average, I've been able to consistently earn returns in excess of 20% per year since 2007. And this includes the financial crisis, in which my stocks just were, destroyed, just as everyone else's. And just don't get me wrong, I don't tell you this to brag about how good I am or whatever. I mean, I only show this to you so you can get a feeling of what is possible if you apply a value investing strategy. And during this presentation, you learned that I absolutely sucked at investing. But because I studied how the best in the world earn money on the stock market, I managed to earn these returns. And seriously, there's nothing magical about this. The strategy is really simple. All you do is find great companies selling at discount prices. And you can do this as well. You can earn these returns. I mean, at the beginning of this, wait, I see someone asked, what are some of your current holdings? Peter asks. I'm not sure how that works with sort of, am I even allowed to share that? Sort of like, am I not? Well, there are not that many people in the webinar, so probably it doesn't really matter if I share it with you guys. Yeah, well, so for example, one of my holdings at the moment is Apple. I've been a big fan of, like you see in the list, I first owned Google. It started rising, and at around 800, I decided it was not worth keeping it in my portfolio because I thought the intrinsic value was around 800 at the time. So I decided to sell it. I made a nice profit, and I put that money into Apple. So yeah, I own Apple. I own some obscure companies. One of the companies I really like, and I think you guys might, I'm not giving it as a stock tip or whatever, but look into it because I think it's an amazing company who does amazing things as well, and it's also nice and profitable. It's called Female Health Company. FHCO is the ticker symbol. Yeah, so those are two of the companies I currently hold. I always have a portfolio of less than 10 stocks. At the moment, I own just 4 because the market is sort of in a state of almost being overvalued or already overvalued. And of course, even still, if I find a bargain, I buy it because I don't let that stop the fact that the market as a whole is overvalued stop me. But still, yeah, I only have 4 portfolios at the moment, 4 stocks in my portfolio. So Michael asked, do you know what happened to Apollo Group after a few years? Yeah, I know that the stock kept on declining after I sold it. So like I said, I bought it at $56, and at some point it was just $17. That's a massive decline. So yeah, I got out sort of, even though I took a big loss, I still got out sort of at a good point. It's now back up at 26, I believe. Still, I wouldn't own it. I mean, they were making a lot of money from. So Apollo Group is an education company. They own the University of Phoenix, for example, and a lot of people got student loans and that's why they could pay this private university institution that pay the fees. However, now there's this whole sort of, the government is sort of trying to cut down on these student loans, and that's really hurting Apollo Group. So I would stay away from it. And now, what is your average holding period? Why would you get out of the value companies? That's a very, very good question. I really like to answer that as well because it's very important. My average holding period I think the average holding period is somewhere around 2 years, maybe. But it differs greatly because some companies I sell after 4 months, some companies I sell after 4 years. It just depends on three things. Is the company, if a company approaches its intrinsic value, that means that I don't see much more upside potential. That's when I sell. I also sell when I notice that I made a mistake, as I did with Apollo Group. Only I should have realized my mistake earlier. The third thing is when I find a better opportunity, like I just explained with Google and Apple. Google rose to $800, and Apple at that point was at, I think, around $450 or $500. And I thought, well, they have sort of the same. They're both really profitable, and of course they're different businesses, I understand, but they almost had the same earnings per share. So, but Google was, or Apple was almost half the price of Google. So also at that point I thought Apple is a better opportunity, so I sold Google, took my profit there, and put it into Apple. So those are the three things when I sell. What's the percentage I got invested? At this point, Michael, I think I have, yeah, I've 60% invested and 40% in cash. I mean, I don't usually have that much cash on the side, but at this point, I just find it very hard to find really good value. So yeah, that's why I'm 60-40. But let me just quickly continue. That because at the beginning of this webinar, I promised to show you how to get more help if you want it, and yeah, this is it. So I'll just do the thing is, the Value Investing Bootcamp is an online video course I have been developing in the past few months, and it literally contains everything I learned about the secrets of the best investors in the world, and it's all in one single package. I put all my sweat and tears into this. It's really been working my ass off these last few weeks just to sort of wrap it up, and it's a really great course. I mean, it covers everything. You can go from an absolute beginner to an investing pro in just a couple of hours. And at the end, you will be able to pick winning stocks and manage your own portfolio with confidence. And even if you already know the basics of value investing, I'm 100% sure this course will teach you some additional tricks. Because remember, like we covered before, you should never stop learning. And besides over 3 hours of quality video content, the course contains spreadsheets to speed up important calculations, but be careful with them, like we discussed in this video. Don't trust those results blindly. It also includes ebooks to deepen your understanding, and quizzes to test your knowledge, checklists to help you apply the value investing principles consistently.